Inflation. Inflation is a fundamental economic concept that affects our daily lives. But what exactly is inflation? Simply put, inflation is a sustained increase in the general price level of goods and services over time. It erodes the purchasing power of money and affects both individuals and economies. To measure inflation, economists use various indicators, such as the inflation rate and the Consumer Price Index, CPI. The inflation rate quantifies the percentage change in prices over a specific period, while the CPI tracks the average price of a basket of goods and services commonly consumed by households. Inflation can arise from different sources. Let's explore three main types of inflation. Demand pull inflation occurs when aggregate demand exceeds the available supply of goods and services, leading to increased competition and higher prices. Cost push inflation, on the other hand, occurs when production costs, such as wages or raw materials, rise and businesses pass those costs on to consumers, causing prices to increase. Built-in inflation refers to the inflationary expectations that become embedded in the economy. When individuals and businesses expect prices to rise, they negotiate higher wages and set higher prices for their goods and services, perpetuating the inflationary cycle. Understanding the causes of inflation is crucial to comprehend its implications. Here are some common factors that contribute to inflation. Excessive money supply. When central banks increase the money supply faster than the growth of the economy, it can lead to inflation. More money chasing the same amount of goods and services drives prices up. Rising production costs. If the costs of labor, raw materials, or energy increase significantly, businesses may pass those costs on to consumers in the form of higher prices. Global economic factors. International events, such as changes in exchange rates or fluctuations in commodity prices, can influence inflation. For instance, a depreciation of the domestic currency may increase the cost of imported goods, leading to higher prices. Inflation has a direct impact on individuals and households, affecting their purchasing power and overall financial well-being. As prices rise, the value of our money decreases, leading to a decline in purchasing power. This means that the same amount of money can buy fewer goods and services over time. Everyday expenses such as groceries, housing, and healthcare become more expensive, making it challenging to maintain our desired standard of living. Inflation not only affects individuals but also poses challenges to businesses and investments. Businesses face increasing costs for raw materials, energy, and labor due to inflation. These higher production costs can squeeze profit margins, forcing businesses to make difficult decisions such as raising prices, cutting costs, or even laying off workers. Investments are also impacted by inflation. As prices rise, the value of fixed income investments, such as bonds, may decline in real terms. Investors must carefully consider the effects of inflation when planning for retirement, building wealth, or preserving the value of their assets. Inflation has broader macroeconomic consequences that affect the overall health of an economy. In extreme cases, high inflation or hyperinflation can have devastating effects on an economy. It erodes trust in the currency, disrupts business activities, and can lead to social unrest. Even at moderate levels, inflation affects key economic indicators. Central banks often respond to inflation by adjusting interest rates. Higher interest rates can slow down economic growth and increase borrowing costs, impacting employment levels and the overall economy. Inflation is a complex economic phenomenon, but there are strategies that policymakers can employ to combat its effects. Monetary policy, conducted by central banks, plays a crucial role in managing inflation. Central banks have tools at their disposal to influence the money supply and interest rates. Central banks can adjust interest rates to control borrowing costs and encourage or discourage spending and investment. They can also engage in open market operations, buying or selling government securities to influence the money supply. Additionally, reserve requirements on banks can be adjusted to influence the amount of money available for lending. Fiscal policy, determined by governments, can also impact inflation. Governments can influence inflation through their spending and taxation policies. By adjusting government spending, they can stimulate or dampen aggregate demand. Taxation policies also play a role in managing inflation by affecting consumers' disposable income and influencing spending patterns. In addition to monetary and fiscal policy, there are other measures that can be employed to combat inflation. Wage and price controls are direct interventions where the government sets limits on how much wages or prices can increase. Income policies, such as collective bargaining and wage negotiations, can also play a role in managing inflation. Another measure is the issuance of inflation-indexed bonds, which provide investors with protection against inflation by adjusting the principal and interest based on changes in the inflation rate. While moderate levels of inflation can be managed, extreme cases of inflation, known as hyperinflation, can have catastrophic effects on economies. Hyperinflation is an extreme form of inflation characterized by a rapid and uncontrollable increase in prices. It is typically accompanied by a significant devaluation of the currency and can lead to economic instability and social upheaval. Hyperinflation usually arises from a combination of factors. Excessive money supply, often resulting from unsustainable government deficits, can flood the economy with currency, leading to hyperinflation. Fiscal mismanagement, such as uncontrolled spending or large-scale borrowing, further exacerbates the problem. Loss of confidence in the currency can trigger a vicious cycle of accelerating price increases, as people rush to exchange money for goods and assets. The consequences of hyperinflation are severe. Prices skyrocket, making it nearly impossible for individuals to afford basic necessities. People's savings become worthless, wiping out their financial security. Businesses struggle to operate, as the cost of inputs surges and customers' purchasing power diminishes. Unemployment rises, and social unrest can erupt as people protest against the deteriorating economic conditions. History provides us with notable examples of hyperinflation and valuable lessons learned. Zimbabwe, in the late 2000s, experienced a hyperinflation crisis that rendered its currency practically worthless. More recently, Venezuela has faced a similar plight, with hyperinflation eroding its economy and causing immense suffering for its citizens. These examples highlight the importance of monetary and fiscal policies, and maintaining the public's trust in the currency. That concludes our discussion today on the topic of inflation. We have explored the importance of understanding inflation's impact on individuals, businesses, and economies. We have seen how a low or moderate level of inflation can bring certain benefits, while hyperinflation poses severe dangers and consequences. Thank you for joining us in this exploration of inflation. May the knowledge gained empower you to navigate the complexities of inflation and foster economic well-being in your personal and professional lives.